Cryptocurrency fans are hopeful about a major event that happens every 4 years, which reshapes the code of Bitcoin, the world's top digital currency. They expect it to sustain the current market uptrend. However, the event could also spell trouble for some Bitcoin miners. Every 4 years, an event called halving happens. Historically, this has witnessed a huge increase in Bitcoin's value. The past 3 halvings in 2012, 2016 and 2020 saw Bitcoin's value jump around 8,450%, 290% and 560% a year later, according to Bloomberg data. As the name, halving, implies, it reduces the amount of Bitcoin miners can earn for validating transactions using powerful computers. The upcoming halving in April 2024 will lower miners' rewards to 3.125 Bitcoin per block, currently worth $94,438, from the present reward of 6.25, or $188,876. Many cryptocurrency supporters perceive the dwindling supply as a factor upholding Bitcoin's value long-term, at least until the total number of Bitcoins that can ever be mined, 21 million, is met around 2,140. Until now, miners have managed to compensate for the drop in rewards post-halving due to the surge in Bitcoin's value and advances in technology that have made mining more efficient. The economics of crypto mining appear more difficult than in the past as the next halving event approaches. Duran Melarud from Hashrate Index suggests that almost half of miners may face problems as they have inefficient, high-cost mining operations. The most prevalent mining machine's break-even electricity price is predicted to fall to 6 cents per kilowatt-hour, kWh, from 12 cents, post-halving. Melarud asserts that around 40% of miners have operational costs per kilowatt-hour that are still higher. He indicates that those miners with operating costs surpassing 8 cents per kilowatt-hour, as well as smaller miners who hire rather than own their mining rigs, could find it hard to remain profitable. Wolfie Zhao from the Miner Mag noted that comprehensive costs for certain miners exceed Bitcoin's current rate, meaning that many less efficient miners could start losing money. While Bitcoin's price has risen by over 80% to roughly $30,000 this year, it's still below half of its peak of almost $69,000 recorded in late 2021. Concurrently, the rise in electricity costs has led to increased production costs for miners, with many finding the debt burdens unmanageable. Ethan Vera from Luxor Technologies has estimated the global mining industry's debt to be between $4.05 and $6 billion, a drop from $8 billion in 2022. This takes into account various forms of debt, including senior debt, loans secured by mining rigs, and Bitcoin-backed loans. A Hashrate Index compiled data reveals that 12 leading public mining companies, such as Marathon Digital Holdings and Riot Platforms, had around $2 billion of outstanding loans by the end of the first quarter, experiencing a slight drop from $2.3 billion in the preceding quarter. A rush to borrow money among Bitcoin miners was partly influenced by their move from China to North America, following China's ban on local mining in 2021. Miners are starting to leverage the readily available debt financing options in America as they couldn't do so in their home country. Furthermore, increased competition in the mining business is narrowing profit margins. The difficulty in mining Bitcoin, indicating the amount of computing power required, reached an all-time high in June. To maintain current profit levels after Bitcoin's value is cut in half in a process known as the halving, its price will need to reach between $50,000 to $60,000 in the coming year, according to Digital Currency Group's Foundry's SVP of Mining Strategy, Kevin Zhang. Although Bitcoin's price rebound and lower electricity costs provided temporary relief to miners, rising power prices are becoming a concern again, especially in places like Texas, a significant crypto hub, currently grappling with a heat wave. To guard against the potential impact of the halving, miners are taking steps such as securing electricity prices, stacking up funds, and reducing investments. For instance, Zhang points out that miners are becoming smarter with power costs and securing prices from their providers early. Companies such as Hut 8 Mining Corp. Are securing credit. It arranged a $50 million credit facility with Coinbase Global Inc.'s unit last month to maintain their Bitcoin funds amid the halving. Texas-based Bitcoin mining firm, Lotta Yotta is ensuring a 6-month cash flow and scaling back investments in preparation for the event, says its CEO, Tiffany Wang. She cautioned against additional investment in Bitcoin mining facilities during the halving year, advising it's safer to save some funds to keep the business operational. The process known as halving is predicted to increase the cost of producing Bitcoin to around $40,000, twice its current value, according to a team of strategists from JP Morgan Chase & Company, led by Nikolaos Panagurtzoglou. Feminamag's data shows that the cost to create one Bitcoin varied from approximately $7,200 to $18,900 during the first few months of this year among a sample of 14 miners that went public. However, this cost calculation doesn't include other significant expenses, such as interest payments on debt, executive pay, or marketing, as pointed out by Zhao. As a result, many miners could be forced out of the market, warns Wang. Therefore, everyone must be ready for this potential shift.